So the Dow Jones Industrial Average did its best NASA impersonation today, looking like it took off to Mars. So we're going to break down an interesting pattern, exhaustion type pattern that developed on that blue chip index, coming one day after the NASDAQ itself formed an interesting pattern that I highlight in today's video as well, and a day after the Russell 2000, which significantly lagged behind the blue chip index, formed an overbought cluster yesterday. So I'm going to break all those technical exhaustion patterns down. I'm also going to show you a way, yes, we've had some stocks that are very bullish that have really gone up today. Can we buy puts on any of those? What's the best way to do that? Is there a safer way to do that where I can manage my risk better, not look like I'm crazy for doing bearish trades in a really bullish market? So I'm going to break that down with today's trade idea. So let's go ahead and get started. Today is Thursday, November the 30th, 2017. My name is David Settle. This is my market outlook for today. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel. Hit that red button. Right next to that, hit the thumbs up. That lets me know with one click that you liked today's video, that you got something useful out of it. Scroll down to the bottom, comment on anything that you did get out of today's video, anything you learned, any light bulb moments. In the description, you'll see multiple links to join my email newsletter, as well as you'll see my Facebook group link there, my Twitter and Facebook page links as well. Follow me on Twitter for more content in addition to these videos. You see my handle there at the top, at DavidSettle42. Like and retweet today's market outlook tweet that's pinned to the top of my timeline. Also, join our Market Outlook community. Go to Facebook. There's the address that goes to our Facebook group. Type in that address and click on that join group link. All right, well, let's look at the market forecast indicator here on the S&P 500 to start off. And of course, a nice rally today again. Tax reform related, of course, with John McCain's vote coming in, so to speak. A little bit of wishy-washiness at the end of the day, and that's why we have that dreaded long upper shadow that we don't get when we're bullish. We don't get long upper shadows, and that's a longer one than we've seen. And as I mentioned before, we're getting big ranges with big volumes. We'll see that here more in a minute. That's not the most bullish when we see those things. So that's why I'm a little skeptical about this run that we've had here. It's quite the run. That's great. It's a 3-day move. There might be some opportunity right now to take some of that profit because of how big and how fast that move was. I mean, for that matter, how big and fast this 3-week move has been. Essentially from 225.64 up essentially almost 100 points in a matter of 3 weeks. Very big rally. You notice the near-term line and the momentum line both came down, mostly because of that long upper shadow. Still have a strong bullish posture. You still have very high and very bullish long-term market sentiment. So I don't want to necessarily say, hey, man, we're in that bear market right now. Of course not, right? We're in a strong bullish trend, and you always trade the trend, but you don't have to trade the trend the same way as you trade the trend in other areas. So keep that in mind. We are bullish, and we are strongly bullish, but there are times, when you're strongly bullish, like here, that you'll trade a certain way, and there are times when you're strongly bullish, like when you're 4 months into it, or 3 months into it, starting to go more, you'll trade that strongly bullish much differently. So, I want to make sure that I make myself clear on that concept. You don't always have to be strongly bullish. You don't always have to be strongly bearish. When you are strongly bullish, you don't always have to be trading the same way over the course of the entire strong bullish trend, right? Because there's a there's a typical time frame to these things. And what we've mentioned before is when this green line crosses above 50, the typical time frame is 1 to 3 months. And we are now almost maybe a day or two away from 3 months of having this trend. Yes, we had a weak bearish posture there, but not enough of one to get below 50. And so that's why this run hasn't ended yet. And we're kind of getting a little bit of a blow off here. A little concerning in that regard. We'll take a look here at some other charts, and more so than anything in the Dow Jones. You can see, look at the Dow Jones Industrial Average, up 1.4%. So almost double the return of the S&P 500. Now remember, this is the bluest of blue chip stocks, the Dow Jones. The S&P is the 500 biggest companies in America, large cap, safe haven, relatively speaking, in terms of the equity universe compared to small caps. Well, among those 50, these would be the bluest of blue chips here, the Dow Jones. Only 30 of those 50 stocks, and when it's outperforming it like this, really crazy. In fact, if you take a look at the relative strength here, whoops. You have to close off those parentheses. When you look at the relative performance of the Dow Jones compared to the S&P 500, I mean, really, it's been doing very, very well over, you know, the course of this whole time frame. Here, let's go to a 5-year chart, a weekly chart. You can see, let me look at since the election, well, before the election even, it's been the Dow Jones that has been just really killing the S&P 500. So, you know, that's not the most bullish of patterns. Obviously, you can still have a bullish trend, so it's not bearish pattern either. But definitely something to be a little bit cautious about. And you can see when we had QE3, like over 2013 all the way through the end of 2014, when the market was as bullish as it has been over this since 2009, you can see how, in fact, let's go back even further. You can see how that relationship goes. When you're really bullish, this line goes down. The Dow Jones, you know, heads down. This is QE. This is Operation Twist that led into QE3, and then you can see all the way down to QE3 ended right here. We went sideways for a while, and then now you can see we're ramping up. But you can see also there's other times. 2011 was a strong ramp up move in the S&P. Here, let me put the left scale on the chart here. You can see right there, during this time, 2011, the S&P was flat during that time frame. So it's a little different here. Obviously, we're not flat. This has been a very, very strong and record-breaking run in the S&P 500. You can see over here when this line went down, it started to go down before, so the market started to rally here. We made another leg lower in 2009, but then as we rallied up, this relationship went down. Again, when you're the most bullish, the relationships will go down. This is QE2 right here. You know, the Dow Jones dropped and the S&P, and now we're getting the Dow Jones really taking off. And again, we've seen this before, but when we've seen this before, I mean, look at the bearish runs when this relationship moves as much as we are. So just something, just a little caution thrown to the wind there. Of course, the NASDAQ Composite, which had such a bad day yesterday, and there was a really interesting tweet that I tweeted out today here. You have to scroll down again at DavidSettle42. That looks at days when the NASDAQ Composite drops more than 1% while its new highs hits a 40-day high. So it's the new highs versus new lows on the NASDAQ Composite was the highest it's been over the last 40 days. So a 40-day new high on the same day that the total index, which is market cap weighted, which means the bigger companies, dropped. The whole index dropped 1%. So there's only been 10 occurrences, according to Dana Lyons' database here, since 1988. And you can kind of see that, you know, a lot of them occur when we're bouncing off lows. That makes sense, right? You're kind of bearish. You kind of get strong moves off of that. A lot of the times can be small cap related. So you can see a lot of times they're coming up off of lows or going down on a bearish move. And you can see even here, there's your 2011 low that we bounced off of. But there's also been times where it occurred at highs. Of course, both of these market peaks before we dropped. And so now the question is, are we coming off of a low right now, a significant low, or, which, you know, the last significant low point occurred about a year ago, a little bit more than a year ago, or are we closer to a high similar, especially kind of a blow-off high that we had in this case in 1999, early 2000s. So that's a very, very interesting tweet that shows just how interesting yesterday's move was. We did bounce back a little bit today, but again, dreaded long upper shadow. Let me get rid of that long left scale. Well, in this case, excuse me, a Harami pattern. There's the shadows on the S&P. Look at that Harami pattern. So that's a bearish pattern in and of itself. So definitely something to keep an eye on. And then you look a bearish pattern at the end of an extended bullish run, right? Obviously, it can be a bullish pattern too, but usually at the end of a extended bear, not just a one day, but more of an extended bearish run. So that's the Nasdaq, and you can see it pretty much matched the S&P. Remember, the Dow doubled that. Now let's take a look at the Russell 2000, your small cap stocks. Only up 0.12%. So way underperforming the S&P, and definitely way underperforming the Dow Jones Industrial Average. And again, extended long upper shadow. So coming a day after getting a bearish cluster, an overbought cluster on this day right here. So, you know, definitely a lot of red flags in terms of, I mean, when the market's looking like when the Dow Jones Industrial Average, and even this chart is looking a lot like the Bitcoin chart, then, you know, who knows when it's going to turn down, but you got to know that the risks are increasing the higher it goes. And you'll see some other charts, you know, as we transition to some of these other technical indicators too, but it doesn't change the trend, still strong bullish trend and all that, but the risks of maintaining that trend start to increase significantly. Like I said, the more and more these charts look like, in this case, Bitcoin, the latest crazy bubble that the financial markets are having. Here's the long-term trend again. That 50-day moving average significantly above, higher than it's ever been above the 200-day moving average on an absolute basis. Of course, you know, back here, you know, we were 100 points, 103 points, 104 points and a quarter off of the S&P 500, but the S&P 500 on that day was at 1842. Now we're at 2647. So, you know, that's, you know, we're not as high as we were in 2014, and that was the highest point, you know, it's been, and obviously it kept going up there. So that doesn't necessarily mean we're going to drop, but, you know, it is. I mean, you can see if I were to change that MACD and to look at how far up above we are the 50-day moving average right now, and you can see, look how high we've gotten. So some of these other cases here, you know, here's the last time we've been about this high, and that's about as far as we got before a brief turnaround. You can see over here kind of a similar move. This kind of blow off top led to about a 4, 5, 6 week sideways move. You can see here again, you can see the sideways action this far up. Over here we got about this far up. You know, we had some ups and downs, so we had some more, even though we went sideways, we had some more volatility, some more significant ups and downs. Here we got this far up above, and you can see again big ups and downs with sideways action, but that was with the MACD really flat. So come back over here where we've been this high up above, and here we go some other times when we get this far up, you know, we rallied there. Here we kind of we increased in volatility after getting that to that point. Over here you can see again about a 4-week up and down move, bigger moves eventually. And then over here is we had about a 4 out of 5 week drop in 2013 when we were significantly above. So, you know, this, if we finish here tomorrow, and again, tax reform pending, right? But if we finish up here or higher tomorrow, then that's going to be, you know, significantly higher off this 50-day moving average. I wouldn't necessarily say that it's like, okay, you know, it's a breakout move and all hands on deck for the bullish train going forward, right? The trend is still bullish, but it's not back up the truck bullish, so to speak. You look at the 3 green arrows, and again, remember, you don't have to be back up the truck bullish when the posture is strongly bullish at every point of that trend, right? Early on, yes. 3 months in, still be bullish, but dialing it back. Definitely dialing it back. And you can see from a 3 green arrow standpoint, that MACD, look how strong it's gotten. So just like that, it's gotten right back up to where we were in pre-October, the 8-day above the 17. And again, if I were to change that MACD down there, just to show you how far up above the 8-day moving average we are. So there's the 8-day moving average, and we are, I mean, the last time we were this high up above the 8-day moving average was last November, coming right off the election and then that's what happened. So we had the big rally right after the election, big news event, right? And then we went sideways as these lines came down. So you can see it's not, you know, that it's bullish. It's crazy to get us up to this mark, and the Posh has been bullish this whole time. But you know, this indicator in and of itself doesn't mean that we're going to now be crazy bullish from today going forward. In fact, it probably says that if we are going to remain bullish, it's going to be, you know, not so bullish. And you can see the stochastics, while still in the upper reversal zone, came down again because we're not closing at the high. So 2 days in a row, when you're bullish, you close about as close to the high as possible. When you're not, when you're bullish, but there's a little bit of an asterisk there, then, you know, it's almost like, you know, over here is kind of like a Roger Maris home run, and over here is kind of like a Barry Bonds home run. There's a little bit of an asterisk there, because it might be a little juiced to get to this point. Apologies to any San Francisco Giants fans out there. I'm a huge fan. I love the Giants. I love the organization. I love the team. And man, you got the best stadium in baseball in terms of view. But, you know, it's a little juicing going on there. So if you look at the intraday chart, you can see, first of all, we gapped up above yesterday's high and the 4-week high. So now we're going to move this. Whoops. We're going to move this 4-week high up again to there. There we go. So strong move. You can see the 4-week low point's not even in the picture. It hasn't. So we're significantly above that 4-week low point. You know, we're now more than 10 points. Great. But again, now, you know, when you look at the expansion contraction, this is a pretty decent expansion, and we've expanded quite a bit in just 3 days. Now it's going to be hard, you know, to expand further. About 10 points is what we've seen in terms of the width of this channel, at least recently at current levels. So because I look at this every day, right? So that's a pretty high level. We finished in the middle of the day again, and we didn't finish at the high of the day. That was early, so little bit of a neutral asterisk in there. You can see the volume, the trading range. First of all, if you look at the close yesterday, 262.71, and the low point today, 263.67. So it's almost a whole point of gap that we had. Then you add on the range of 2 1/3 points next to the R right here. So you had about a 3 1/3 point range today, and you can see the volume almost hit 3 standard deviations. Way more volume than we've had since these down days. In fact, we haven't had this much positive volume since March 1st, coincidentally. And if you look at the diamonds, the Dow Jones, which is the one that went up the most, it did get 3 standard deviations of volume. And again, the last time we've had this much positive volume, we had it coming up off a low point here. But in March, we had this strong high point. Kind of, again, 3 standard deviations back then too, and it was a little bit of a blow-off top to where we eventually had a couple months of pull. I mean, again, that's not earth-shattering pullback. That wasn't even trend-changing pullback. We easily stayed above the 200-day moving average, right? So I'm not espousing that we're gonna tank now. But man, it's hard to maintain that when a rocket ship goes up. When it goes up this far at this angle, when a rocket ship goes up, it uses all of its energy to get up, right? It's almost like the NASA uses those rockets to break Earth's gravity. In this case, to break the linear regression gravity, so to speak. And now it's gonna, it's run out of rocket fuel. It can still go up, and the boosters come off. The spaceship still goes in outer space eventually. But it broke gravity and needed the fuel to break gravity, and now it's run out. You would expect it to run out. Not that it's gonna fall back down, right? Fall back down to Earth. But in terms of, like, again, are we gonna continue to get these kinds of days? Barring anything happening with that Senate tax reform, and of course, if it doesn't pass for whatever reason, holy cow, yes, then you would expect this thing to come rocketing right back down to at least the moving average. But if it does pass, which is expected now, that's why the market's rallying so much, then you're probably just going to kind of you're going to get you're most likely going to get a sell the news phenomenon where we bought the rumor like crazy, and then you'll finally just sell the news after the fact. So you see the range 3, and it was the volume. Let's go back to SPY. Volume was at 126 million. So we'll put that in some context here. 126 million is off the charts. The range 3 and 3rd points for SPY off the charts. That's, you know, off the charts is great when you're coming up off of a significant low point. Off the charts is great when you are breaking through a significant resistance. Like, you know, we've had multiple touches at these levels previously that now we've bounced back up and hitting them again, and we're busting through. So it's great when you have those things. It's not so great when you're already really darn bullish. And you can see not everybody thinks that this tax reform is going to pass. It's not 100% odds. It's decent odds. It's better than expected. It's higher probability. But you can see the VIX is like, people are still buying up, but they're buying protection, right? They're not so, even if there is a sell the news phenomenon that occurs after this bill passes, it's interesting to see that volatility has not been dropping these last 3 days, and you can say instead it's been rising on an absolute basis and a relative basis. So, which means the relative basis means that all the volatility right now is in the next 30 days compared to, you know, it's rising more in 30 days than it is rising in the 90 days, because, you know, again, if that bill passes or not, you're either going to get a sell the news, or you're going to get a, you know, sell this rip. If it doesn't pass, which puts all the risk and pressure in the next, well, for that matter, not just 30 days, but the next really week to week and a half, 2 weeks. Now, as we transition to what's driving the market, I did want to make another plug. I appreciate all the, look at all the likes and the retweets, over 100 combined likes and retweets. And the reason why, I wanted to briefly mention why I ask for your likes and your retweets. Again, it's always pinned at the very top of my timeline, David Settle 42, if you follow me there. If you don't follow me, hit that button right up here. It says edit profile for me. It'll say follow for you. But the reason why I ask you to do this, because if you notice, when you on Twitter, you don't see all the tweets from everybody you follow when you pull up your Twitter account, like on your phone or whatever, or on the desktop. Twitter will show you tweets from people that you engage with the most first. So if you're engaging with these tweets, then I would qualify as one of those people that you engage with the most, and they will push the tweets that get the most engagement to you first, because they think, well, if people are liking it, then you probably will like it too. So that's why I asked, you know, for you to like and retweet, not necessarily because you've got 1 million followers and I want all your followers to see that, because I don't even have 1 million followers, right? But it's mostly to show that there's engagement on this, and then that will start to push this tweet to everybody who follows me, and to you who would engage with me. It will push it to you too, to make sure you're seeing what I'm tweeting out, not just the market outlook tweet, but all the tweets that I push out there. So the more you like any and all of these tweets, the more you will continue to see all my tweets, and everybody else who follows me will continue to see those particular tweets as well. All right, so when you're looking at the major asset class, it's interesting that the biggest gainer today was the S&P 500, right? And then really it was the Dow, right? Because the Dow had almost double that return. So it wasn't all 500 stocks. In fact, the more mid-cap stocks in the index lagged behind. It was the bigger companies that rallied so much. You can see the small cap index, everything's outpacing. In fact, even emerging markets. Emerging markets, which has really been outperforming year to date, you know, doing very, has had the best returns. You can see gold's also lagging behind here, with the dollar doing relatively well. The dollar has been underperforming all year long, but you can see that emerging markets has benefited from that weak dollar. They've been rallying, and now looks like they've pulled back to a low point here. Now, the past low points have been buying opportunities for emerging markets. So we'll see if this one ends up being the same. You'll know if it's not, because if it doesn't hold this low point from here, this old high, this area here, then that relationship now is gonna reverse for more of an extended period of time. Otherwise, you can expect, you know, stocks or whatever to bounce off support until it doesn't. So we expect that it will bounce off this level and start to outperform again, especially if U.S. stocks start to sell the news, right? Start to underperform or start to give up some of these really crazy profits that we've seen in the past week. All right, so go back to what else has been driving the price today. You can see that treasury yields continued their climb higher. Now they rallied a little bit. Treasuries rallied at the end of the day, still finished down, lagging behind high yield. You can see developed markets and the large cap index outpacing the more risk, their riskier peers. So large caps over small caps, developed over emerging. Crude oil outpacing gold, even though they were both down, and of course high yield outpacing government treasury, and the dollar lagging behind all these, crude oil, high yield stocks, large cap stocks, and even including US small cap stocks. So the dollar dropping some there, and gold, really that's a significant drop for gold on a day when the dollar was actually down. You would have expected gold to be up. So you can see all currencies really dropping. It's a paper currency world that we live in right now. I'll briefly look at the calendar. You can see the biggest news today was the price, consumer spending, and income. If I drop down here to the yearly, which is the more important one, PCE, which is the Fed's preferred measure of inflation's not very strong, still a little bit over 2%. The income jumped up significantly year over year, this pink line. So that's one of the strongest incomes we've had since QE3 ended. QE3 ended, we've been dropping in year over year growth. Now a stronger positive number that we've had for over a year in terms of, again, year over year growth. That came out today. So some inflationary pressure there. Even though that didn't really impact rate hike expectations. For March now, we're still got the 1, which is higher than none for March, right? So we're getting decent odds there. They're both still right around 40%. So it's still kind of a coin flip as to whether we'll get one in March or not. There's the Citigroup Economic Surprise Index, still very high. The other major report that came out today was the Chicago PMI. Wasn't as strong as the previous number, but a little bit stronger than expected. So the market was expecting a little bit of a pullback. You can see at above 60, it's still a very high reading for this indicator. This is sentiment. This is a survey, right? So this isn't actual manufacturing data. This is just surveys of what businesses are expecting. So still that strong sentiment still out there. And if anything rattles that sentiment, that's what's really been driving this PE expansion. If anything rattles that sentiment, then it can drop. From a sector rotation standpoint, remember yesterday's move. We've had this week. We've had financials outperform. We've had industrials outperform. Technology lagged behind. Safe haven areas continue to get hit. In fact, you can say over this 3 days we've been so strongly bullish. There's your industrials, there's your financials. You can see energy is kind of taking its turn today to doing very well and outperforming. In fact, just about every sector is outperforming except for those 2 interest rate sensitive sectors, utilities and real estate, both lagging behind significantly. Real estate to the tune of, even though housing numbers have been very, very strong, those yields rising again have put some pressure on there. And you can see technology bouncing back up today, but still really showing some strengths or some underperformance. So you can see it was energy's turn today to lead the way market. And when the correlations are as low as they are, you'll see sectors just taking turns leading one way or the other. But again, we've had a little bit of a we've been pushing higher so far so fast. So we can see it's not normal for industrials to be up 5.5% in the course of a couple of weeks, and with most of that coming really in the last few days. We were only up 1.5% just a few days ago, and now up over 5.5%. So that kind of move isn't the most normal to get 4.25%. So there's a way we can take advantage of that. And that's where today's trade idea comes from. One of the stocks that's impacting the Dow more than any other because of its price. See, the Dow is price weighted. So like S&P 500 index is market cap weighted, and the NASDAQ composite too for that matter. The Dow Jones Industrial Average is price weighted. So the higher price companies impact the index more than the lower price companies. So for example, GE has been one of the biggest companies in the index in terms of market cap, has had an unbelievable bad year, and especially in the last couple of months. Very, very bad move down to, but it's only $18, whereas Boeing, which isn't nearly as big from a market cap standpoint, is much, much higher price, so it has a bigger impact. That's why the Dow looks more like Boeing and less like GE. Even though GE, if it was market cap weighted, the Dow wouldn't be nearly as strongly bullish. So with that being said, Boeing has had a pretty strong move. If I were to, let's get that theme back to where I can see things a little bit better. There we go. You can see Boeing's had, it's a little bit of a strong move here. If I take a look at the volume, the standard deviations, you can see more than 1.5 times getting up to, that we're in a low volume environment. You can see how low it was coming off the holiday. So this is a high volume day compared to where we've been, with the averages dropping as low as they've had. You look at the market forecast, you're getting an overbought cluster. And again, the market forecast has been bullish. It crossed above 50 in April, in middle of April. It came close to, never did get to a lower low here. Came close to dropping below 50. Came close to dropping below 50 in November. Again, not getting to any lower lows. We've been on a 6 month, was that April to November, 7 month? We've been on a 7-month rally. We've got another cluster. We've been getting clusters. This isn't the first one, but we've got another cluster here. This is kind of the first one that's been such a big move in terms of range and volume compared to its averages. And as we talked about with the Dow index, can that be considered? I mean, we've seen this kind of pattern before. Back here was on March 1st, where we had a lot of volume, and even then we didn't have that big of a move like we're having right now. So we don't necessarily want to say, okay, let's buy a put on this thing, because it's on a strong trend. It's on a bullish trend. So can we buy a put in case, because we wouldn't be the only one buying puts right now as we see the VIX is rallying. Can we buy a put here, but do it in a way that's not so expensive? And that's where this calendar spread comes in. So you notice I can buy, in fact, let's see, I think I have the 265, yeah. So let's go to the 265 put here. Here we go. We can take a look at the 265 put for January. And the reason why I'm going out to January is these weeklies have very, very wide spreads, so it's not very conducive to trading. So we'll go out to this January and look to, to the February, look to buy this 265 puts below 40 in the delta. It's cheaper. It's only $6.10. Remember, this is a $276 option. So you'll have wider spreads anyway because of how expensive the stock is. Excuse me. So instead of paying $6.10, I can sell the January put to offset that. So that's a bullish trade, right? I can sell the January put to offset that. Now I'm only paying $3.14 for this trade instead of $6.10. And what that looks like here, so here's the current price, is there's 265 right there. So I'm spending $314. If we drop down to 265, then you see I have a potential reward of about $300. So I have about a 1-to-1 reward to risk ratio. Now, granted, if we keep going up and up, you can see here's the purple line is my profit loss. I mean, just look how gradual that slope is. Now, eventually, as we get closer to January expiration, that's going to drop down from time decay, working against you. But you can see how gradual the slope is if we keep going higher. If we keep going lower, now I'll have time decay working for me. And you can see, here's the standard deviation of where we can trade. My break-evens for this calendar is pretty much in the lower half. So I don't need it to go way down. I don't need it to be bearish. I just need it to come down for me to profit from this trade. And it's basically kind of a hedging trade. I just need it to come down and trade in here. That's where the slices are. So there's my break even to the upside. So it's got to come down a little bit. Basically the midway point of today's kind of blow off candle. And then, I don't need it to be a huge bearish move. It just needs to come back in here. And if it comes back in here and gets to this midpoint, 265, then I'll make as much money as what I spent. And of course, I'm not going to risk the whole $300 because if we keep, rallying, then, if we keep moving this up, and this kind of goes outside of this 1 standard deviation range, then I don't need this trade anymore because it's not going to pull back enough to get to where I need it to be fast enough. Now it basically turns into a long put because my short put runs out of, I've made all my premium. So that's one way you can say, okay, if my short put, because I keep going up and up and up, if my short put, which is my bullish trade right here, if that runs out of premium, then now I just got that long put. It's a bearish trade on a strongly bullish trend, so I don't need to be in this trade anymore. And I'm not risking, that full 314 because I'll probably end up losing about half of it if it keeps going up to the point where I lose all the premium from my short put, the bullish half of this trade. So to summarize, the market is showing some extreme bullish moves, especially in the bluest chip of the bluest chip stocks. And there's some interesting kind of exhaustion patterns developing, technical patterns. Obviously, when the Dow is looking like Bitcoin, like I mentioned before, then you start to look for these kinds of patterns, and they're all popping up everywhere. So I highlighted a bunch of those patterns. It doesn't necessarily mean to tell you, hey, close out all your bullish trades and let's go bearish. But it does mean that we're not nearly as strongly bullish now as when the intermediate line first crossed in the reversal zone almost 3 months ago, right? There's different kind of weightings as to how strongly bullish we are when the posture is strongly bullish. And right now, considering the opportunity we've had as the market's gone up as much as it has in the last few days, there's definitely some opportunity now to take some chips off the table, so to speak. Let your winners run, but take a little bit of those chips off the table and see what happens, especially with this big anticipated news event coming up by the end of this week. So with that said, thank you very much for watching tonight. Remember to subscribe to the YouTube channel, follow me on Twitter. Also remember to like the video on YouTube as well as on Twitter, and also retweet. And if you haven't already, join the Market Outlook community on Facebook. You'll see the link down in the description below, and join our daily email newsletter. Again, thank you very much, everyone. Have a great evening, and we'll see you all tomorrow.